Have you ever wondered how to start investing? Well, that's a question that has crossed many minds, and today we're going to delve into it. The world of investing is vast, vibrant, and full of opportunities waiting to be seized. It's not just a playground for the rich and famous, but a realm where anyone, yes, anyone, can participate and grow their wealth over time. Investing, in essence, is the act of committing money or capital to an endeavor with the expectation of generating an additional income or profit. It's a powerful way to grow your wealth, and the magic lies in the power of compounding. There are numerous ways to invest, like stocks, bonds, and mutual funds, each with its own set of pros and cons. We'll be exploring these in this video, breaking down the jargon, and making it simple for you. So if you're ready to take your first steps into the world of investing, stay tuned. First up, let's dive into the world of stocks. You can think of stocks as tiny pieces of a company. When you buy a stock, you're essentially buying a small slice of that company. This makes you a shareholder, which means you own a piece of the company's assets and earnings. It's like being a part owner of a company, even if your share is minuscule. Now, why would you want to own a piece of a company? Well, when a company does well, its stock tends to increase in value. If you've invested in that company, your stocks can become more valuable, and you can sell them for a profit. That's the basic idea behind investing in stocks, and it's why stocks have the potential for high returns. But here's the thing, stocks also come with a certain amount of risk. The value of a stock is tied to the success of the company. If the company doesn't do well, the value of your stock can decrease, and you might lose money. That's why it's essential to do your research and understand the market before you start investing in stocks. Researching a company involves understanding its financial health, its business model, and its position in the market. You also want to look at the wider economic environment and any factors that could affect the company's performance. It's a bit like being a detective, piecing together clues to form a picture of the company's potential, and about understanding the market, it's about knowing how different factors like economic trends, political events, and even public sentiment can influence the price of stocks. It's a complex world, but it's also a fascinating one. The beauty of stocks is that they give you the opportunity to be part of a company's story and potentially benefit from its success. And while they do come with risks, with careful research and a good understanding of the market, you can make informed decisions and potentially reap substantial returns. So, while stocks can be a bit risky, they can also offer substantial returns if you do your homework. Next, we move on to bonds, another popular investment option. Let's delve into the world of bonds, where the focus shifts from ownership to loans. In simple terms, when you buy a bond, you're actually lending your money to an entity, be it a corporation or the government. In return, they promise to pay you back the original amount, known as the principal, at a specified date in the future, known as the maturity date. But that's not all. Along the way, they'll also pay you interest, often semi-annually, on the money you've lent them. This interest is the bond's yield, and it provides a steady stream of income for the bondholder. Now you might be wondering, why would anyone want to lend their money? Well, that's where the beauty of bonds lies. Bonds are generally considered safer than stocks. While the stock market can be a wild ride, bonds tend to offer more stability. If a company goes under, bondholders are paid before stockholders. This doesn't mean bonds are risk-free, but they certainly carry less risk than stocks. Bonds also play a crucial role in diversifying your portfolio. Having a mix of stocks and bonds can help cushion the blow if the stock market takes a downturn. If the stocks in your portfolio are performing poorly, the steady income from your bonds can help offset those losses. However, it's important to remember that while bonds are safer, they typically offer lower returns than stocks. The same stability that makes bonds attractive also limits their potential for high returns. The interest rate on a bond is fixed, and while it provides a steady income, it doesn't have the potential for exponential growth like a stock might. So if you're the type of investor who prefers a steady, predictable return and doesn't mind sacrificing high potential growth, bonds could be a great fit for you. They provide a solid foundation for any investment portfolio, offering a balance between risk and reward. Bonds, therefore, can be a safer bet, but remember, lower risk often means lower returns. Now let's talk about mutual funds, a favorite among many investors. Mutual funds are a bit like a basket of different investments, all bundled together. Imagine you have a fruit basket. Instead of buying individual apples, oranges, and bananas, you buy the basket and you get a little bit of everything. In the world of investing, that basket is a mutual fund, and the fruits are stocks, bonds, and other types of investments. So, how do mutual funds work? Well, when you put your money into a mutual fund, it's pooled together with the money from other investors. This pool of funds is then managed by a professional who uses it to buy a diverse range of investments. This could include everything from stocks in large corporations to bonds from governments around the world to real estate and more. Now, you might be wondering why you'd want to buy a basket of investments rather than just picking out your favorites. The answer is diversification. When you invest in a mutual fund, you're spreading your money across a wide range of investments. This helps to reduce your risk. If one investment doesn't do well, it's okay because you have many others that might be performing better. It's a bit like having a safety net. Another advantage of mutual funds is their professional management. The person or team managing your fund has the knowledge and experience to make informed decisions about where to invest the money. They do the research, make the tough calls, and generally aim to get the best possible returns for the fund's investors. So, mutual funds offer a way to invest in a broad range of assets without the need to manage each one individually. They can provide potential for good returns, and because of their diversification, they typically come with lower risk than investing in single stocks or bonds. Mutual funds can be a great way to spread your risk while still enjoying decent returns. So, you might be wondering, which investment option is right for me? Well, choosing the right investment isn't a one-size-fits-all sort of deal. It's more like picking out a suit. You wouldn't choose a suit without considering your size, would you? Similarly, your financial goals, risk tolerance, and investment timeline are your measurements for choosing the right investment. Let's start with your financial goals. Are you saving for a down payment on a house, funding your child's education, or preparing for retirement? Your goal determines what type of investment you should lean towards. If you're saving for a short-term goal, you might want to consider a relatively safe investment like bonds. But if you're looking at a longer-term goal, like retirement, stocks or mutual funds might be more suitable. Now on to risk tolerance. Are you the type who likes to live on the edge? Or do you prefer a more stable, predictable life? If you're comfortable taking risks for potentially higher returns, stocks could be your game. But if the thought of losing your hard-earned money keeps you up at night, you might want to stick with bonds or mutual funds, which offer more stability. Next, consider your investment timeline. Do you need your money back in 5 years, 10 years, or are you willing to let it grow for 20 years or more? The longer your investment timeline, the more risk you can afford to take, as you'll have more time to recover from any potential losses. But here's the kicker. Even with all these factors, choosing the right investment can be complex. That's where a financial advisor comes in. They can provide personalized advice based on your specific situation. They'll help you weigh the pros and cons of each investment option and guide you towards the one that best fits your financial goals, risk tolerance, and investment timeline. Remember, the best investment for you depends on your personal financial goals and risk tolerance. After all, it's not just about making money, it's about making the right decisions for your financial future. Let's quickly recap what we've learned today. We've sailed through the sea of stocks, where we saw how buying pieces of a company can potentially lead to major profits or losses. We then dove into the depths of bonds, understanding how lending our money to companies or governments can earn us steady, albeit usually lower, returns. We also ventured into the vibrant world of mutual funds, discovering how these baskets of various investments can offer diversification and professional management. Remember, it's all about doing your homework, understanding the market landscape, and aligning your investments with your long-term financial goals. In this complex game of investing, there's no one-size-fits-all strategy. It's about what works for you, your risk tolerance, and your dreams for the future. So don't be afraid to dive in. Investing can be a powerful tool for financial growth. So, start today and watch your money grow.